Hi, this is Tim Yoder with Fit Small Business. I've been a CPA for 26 years, and today I want to teach you about the Days Payable Outstanding measure. It's a very easy measure to understand. It's simply the number of days it takes you from the time you purchase your inventory until you pay your supplier. So how do we calculate it? We calculate the average accounts payable. We divide that by your annual cost of goods sold and take that times 365. That will give you the number of days it takes to pay your suppliers. So here's the formula written out. You can actually change this formula. One nice thing about this, I'm going to present kind of the way it's generally calculated, but if you want to calculate it differently for your purposes, then go right ahead. This is just for your own knowledge. So this is how we calculate the days payable outstanding on an average basis, right? So 365 days a year times your annual average accounts payable divided by your annual cost of goods sold. Now, if you wanted to do this on a quarterly calculation so that you could track this number quarterly to see if you've made any improvements, well, then you simply substitute, instead of the annual numbers of days of 365, substitute in the number of days in the quarter you're measuring, usually either 91 or 92, divided by the average accounts payable just over that quarter, divided by the quarterly cost of goods sold for just that quarter. So again, you can revise this formula really to measure whatever it is you're looking for. So let's do an example. Our first step is going to be to identify the inventory purchase. So we need to calculate the cost of goods sold. Now, if you're not using software, we're going to have to do this manually, and so that's what we'll talk through first. So you need to identify all your inventory purchases. Then you're going to calculate your cost of goods sold. You're going to take your beginning inventory plus your purchases. That gives us the goods that were available to sell throughout the year. Subtract out what's left over in ending inventory, and that's going to give you your cost of goods sold. So this is going to be our number in our denominator, our annual cost of goods sold. Again, if you want to calculate it over a quarter or even a month, feel free to do so. Next, we need our average accounts payable. Now, the easiest way to calculate average accounts payable is going to be to take your accounts payable at the beginning of the year plus your accounts payable at the ending of the year divided by 2. So in our example, we're saying it's 6,000 at the beginning of the year, 10,000 at the end of the year, divided by 2 gives us an average accounts payable of 8,000. Now, this is not a very accurate average at all. Right? We're only using the year-end numbers. If you would like to calculate this as, say, a monthly average, that would probably be a lot more accurate number. But again, however, if you have accounts payable that are kind of very steady throughout the year, then probably using the beginning and ending is just fine. If your accounts payable at the end of each year tends to be a little bit different than it is throughout the year, then you wouldn't want to do this average at all. You definitely want to do a monthly average. But however you'd like to do it, come up with your average accounts payable during the year, and that's going to be your numerator. So once we have our numerator and our denominator, we simply take our 365 days times that ratio to get us our days payable outstanding. So in our example, our days payable outstanding is just over 30 days. Well, so that's pretty easy to understand, right? So it takes us 30 days from the time we purchase our inventory until the time we pay our vendors. It takes 30 days. So that part's easy to understand. What's a little bit harder is, well, okay, 30 days, is that good or bad? Right? So a lower number here is not necessarily a good thing, right? You want to, cash is valuable. You want to keep the cash as long as you can before paying your vendors, right? So if they give you 30 days to pay, there's really no point in paying them in just one day. So a lower number is not necessarily a good thing. Now, a very high number is clearly a bad thing if it's higher than what your vendors typically give you for your payment terms. And so really what I shoot for is you want this days payable outstanding number to be maybe slightly less than the average payment terms your vendors give you. So if all your vendors give you a 30-day payment term, then you'd like your days payable outstanding probably to be a little bit less than this. Now remember, this is an average statistic. What's really important is that you pay each individual vendor on time, right? So you'll want to go through and make sure that you review your accounts payable on a regular basis. Make sure everybody's getting paid on time. This is really just an overall measure to see perhaps how your days payable might change over time. So if you have QuickBooks Online, it's very easy to calculate this days payable outstanding. Print your profit and loss report for whatever period it is you're wanting to calculate the days payable outstanding, and that report will give you the cost of goods sold. Now, of course, this is assuming you're using QuickBooks Online properly, using the inventory features that it gives you. I will throw a link in the description here to our QuickBooks Online tutorial, Fit Small Business. We have 46 free QuickBooks Online tutorials. Those are free. Browse through them. Learn how to use QuickBooks Online more efficiently. Then you want to print your balance sheet. That will give you your beginning and ending accounts payable to calculate that numerator. If you would rather use a monthly accounts payable, you can print a balance sheet that shows your balance by month for all 12 months, and then you could use that to calculate your average accounts payable. So QuickBooks Online makes this calculation very simple. Again, I'll throw a link in the description to both our tutorials, and I'll throw a link into QuickBooks Online if you'd like to sign up. You get a free 30-day trial subscription, or you can choose 50% off for 3 months. Again, my name was Tim Yoder with Fit Small Business. I hope you found this helpful, and I look forward to seeing you next time.